Welcome to another video, and in this edition we are looking again at the weekly macro themes report. This is the report that goes to our clients, and it covers 5 different topics of interest to sort of top-down driven macro multi-asset investors. So you can see there, for example, in this edition, it was from a couple of weeks ago, you got the macro data pulse. You got property prices, you got global M&A stats, emerging market asset allocations, and a little bit on the Australian dollar there. And what we're going to be looking at in this video is property prices, specifically why you should be looking at global property prices. I mean, to me, it's really one of the key variables to track at a global level and across economies. You can see here the bottom line is this. Global property prices provide important signals for the economic outlook and major asset classes. And currently, it's positive growth inflation and positive for equities versus bonds. And really, it comes down to this. So I'm just going to read out this paragraph here. The economic logic is fairly straightforward. Property prices impact on economic activity. Construction, real estate services, consumer durables, etc. Confidence, particularly consumer confidence, and credit. It improves the credit quality and borrowing capacity of existing owners when it's going up. It also plays a key role in precipitating risks when property prices are heading down. And this is only ever true as debt levels climb. And so, if we look at the charts here, these two charts take it a little bit further and take it as it applies to global markets. And this here dark line is the global GDP weighted property prices year on year or growth rate. And this is tracking it across the major economies, and we've given you a GDP weighted composite view. And you can see there that this lighter blue line, that's the change, year-on-year change in US 10-year bond yields. And you can see that there's actually a fairly decent correlation between the two. You'd actually expect that. You expect it for a number of reasons. So first of all, when bond yields go up, or when interest rates go up, that actually has a sort of a negative impact on property prices because it impacts on borrowing ability and borrowing costs, and vice versa. But probably more to the point is when you have property prices going up, that tends to be supportive for growth and inflation. And if growth and inflation are supported, then that generally means that bond yields go higher. And when property prices start turning down, again, that tends to precipitate a number of risks and tends to put downward pressure on bond yields. And you can see here that the application to global equities, the MSCI All Countries World Index, is more or less the same. And it's a fairly similar logic. You can see there going into the financial crisis, the global GDP weighted property price and growth metric was turning down, turned back up coming out of the crisis. And then again into the Eurozone crisis, they rolled over again, and that sort of was a contributing factor to the market turmoil through those years. And then again, more recently, the property price growth indicator had rolled over leading into the 2015-2016 market turmoil, and it did come with a bit more of a lag than the previous episodes. And it was ultimately averted from going into a bear market because of ECB and China policy stimulus. And you can actually see that when you look at the individual countries, and this is why it can be quite important to look at this view also. So as you see there, when it started going down there, that was largely driven by China and US decelerating. But then you can see that when it turned back up, was driven by Eurozone and China, and that really was, in both respects, a reflection of the monetary policy stimulus packages that were put in place. And that's why, and again, another reason why property prices are key, because they give, a guide to what to expect from monetary policy, but they also really reflect what's going on in monetary policy, and that's an example there. Now, the other reason why I put this chart here is because, really, over the last 6 months or so, and especially in the middle of 2016, prior to that spike in bond yields that we saw and the whole global synchronized rebound, I was looking at this chart and saying this is extremely bullish for the global economic outlook, because this is actually quite a rare condition here. You've got China, America, Europe, and even Japan all experiencing positive year-on-year growth in property prices. This is actually quite a rare condition. The last time that we saw this was actually, back into this pre-crisis credit boom, economic party times period here. And, it's this kind of condition that helps reinforce the positive growth dynamics that we've seen in the global economy. And, again, it's probably a sign that we are getting later on in the cycle, but it's something that will also drive growth in the medium term. And by the same token, this chart, not only does it help support the global outlook at the moment, but, when you see prices roll over in a meaningful way in either one of the major, perhaps more important ones, which is, China or America, if you see a single one of these really drop off in a big way, that lights up the warning signs. If they were all to roll down, then that would give you cause to downgrade the global growth outlook. So, given the impact of property prices, again, the logical and intuitive reason that they have such a profound impact on the economy and confidence in markets, and we can see here that it has very big important impact on markets. This is basically why you should be looking at global property prices, and why indeed it's one of the key things that we track, monitor, and anytime that we see the dynamics start to change here, that's definitely going to be something that's going to be appearing in future reports, either the weekly or the monthly reports. So look, I'm going to leave it at that. And if you've got any questions or comments on this, do go ahead and put them into the YouTube comment section below, and be sure to subscribe to the channel. And again, if you wanted to check out this report or even take up a free trial, just follow the link in the description to the video, and yeah, it'd be good to hear from you.